Yeah, welcome to Macro Pillars on the 20th of April, for those who have joined and those that are listening back. Another weekend of he said, she said, and certainly we're back to the elevation status after the apparent peace discussions last week and ceasefire. The Trump, the U.S. Navy intercepted Iran flagged cargo ship not long ago. I mean, I can go through all the headlines, but yet again, it appears what we get from the president and the administration is vastly different to what we're getting from the Iranians and their allies. Oil is up about 6% aftermarket. Equities are small down. Metals down 2%. We went through this last week, and then the market rallied about 8%. So we'll see. Market overview in terms of macro. It's obviously, again, risk off for geopolitics, but we've had to go back to neutral on liquidity, technical analysis, and market structure due to the most significant and largest rally in 85 years. And we'll talk to some of the dynamics around that because there are some, as we did a lot of work last week and through the week and updated accordingly, there was a lot of, as we've called it, the hand of God, but at display, but also it was market structure, positioning. You don't get that type of rally unless the market was definitely caught off guard.
Big share.
The market structure, yet again, is formalized by the hand of God, if you like, the secondary liquidity that's been coming through the market. And we've seen significant improvements in volatility, which helps market structure, which lowers the move, lowers the collateral required in the market, and as a consequence feeds into what you saw last week. Again, an extraordinary rally. Again, mostly focused in the US, but it's broad enough to be certainly asking questions about whether this is the start of a move or another one that is drawing people in at the wrong time. So we have to go back to the pillars and think through it because we certainly didn't capture it. We certainly looked at it. We were, as you know, conservative from the February dates, and certainly weren't pressing down at the bottom. Have been focused more on real assets than financial assets, but I think we're in a much stronger position going forward as to what we're looking at with respect to these secondary tier liquidity positions and influences and impulses, and and when you line that up with other pillars like technicals and positioning, it's critical. What I try to look through when we're looking at these decisions as to whether we want to be really risk on is looking at liquidity through the multiple lenses. And if we look at back at 2020, it was a significant uplift. As you can see in 22, it was a rate of change significantly lower. And now, standalone, you'd be wondering, well, why on earth weren't you just long on the numbers? Because those numbers were actually a lot closer to red if we'd gone back a bit further 2 weeks ago. Because there's only one dimension really that moved it. I mean, back in 2020, it was fiscal. I mean, they globally, it was a rate of change off the charts. Every government in the world spent a lot of money. It was balance sheet, as I'll show you shortly. It was monetary. It was repo. It was a lot. That's not happening now. What we're seeing now is market dynamics, a very clever Treasury Secretary that's turning up and turning on. And therefore, when he gets the volatility shift, which is why I think we're going to be living in this dynamic for some time, possibly until November, or at least till the Iran situation calms down. And as you can see, week to week, that's almost impossible to predict. But what I am conscious of, if they said tomorrow, and I'll go to the next slide, they did something like this, which they did in 2020, macro pillars would be vastly interpreting the path of the market differently, but they didn't. They haven't done that. They have bumped it a bit. That's why we look at the date. It's the 10th of December, albeit now lots of markets are above that date, but they didn't close above that date until we started using the cash management purchases that we found the last 2 weeks. But as you can see back in 2020, that's just the Fed balance sheet. That was also going on in China. It was also going in Japan. It was also going on everywhere. And that's why the market did what it did back in 2020, when you would have normally thought, well, COVID, world's ended, no one goes to work, economy collapses. Well, no, they replaced the basic GDP with balance sheet and brought forward activity. And then you saw the QT and the consequences of that through 2022. The other thing that I'm always watching, and we're just trying to see, and we'll get to it at the end, but currency, the US dollar, the currencies have been by and large, and I haven't had many positions in them, but we will. They will be one of the major determinants with the yield curve. Now, last week, the yellow line is the global long end yield curve. It's Germany, it's Japan, it's US, it's UK, it's Australia. So when you're getting that steepening going on in the yield curve, that is, rates are going up. It makes sense to be buying protection in terms of assets, be it metals, be it stocks. But last week we actually got the market rates came lower, and we got a bull steepener broadly. That is, short end rates are starting to, I think, pay attention now to the demand shock that the oil price has caused, not the oil supply problem that you would normally be focused on as an investor to give yourself some inflation hedges. And we showed you in the long form note. I'm not sure if we've got in these slides, but the consumer confidence in the US is at 60-year lows. The consumer confidence in Australia is getting close to where it was in 2008, and certainly near the 1990s. Anyone old enough to remember the 1990s, it was not a good time in Australia. So the consumer confidence levels are demonstrating what the bull steepener is starting to do. The demand shock is starting to occur. Hence why I'm somewhat hesitant and certainly reluctant to go to turn positive, even though our liquidity models are suggesting that I should. The factors affecting liquidity, again, I'll defer to Nick now for these next few slides. We've done an enormous amount of work and working with some really good people helping us on our scorecard and our liquidity models to improve it. So we're capturing this. And I'll hand it over to Nick to talk through that.
Thanks, Andrew. So we're going to look at a couple of comparisons today, but it's firstly just important to recap on these charts that we explored over the last 2 weeks, just to understand where the cash management purchases came in and where the liquidity support was and how much there was of each. So this is the tax season of 2025, tariffs, Liberation Day. It's the first time since Bessent came into office that this tentative schedule was put to use between himself and Trump. And it's just important to be aware of these cash management purchases around the lows there. And then, of course, we've all seen this chart, right? This is the current period where obviously we have a lot more activity because it's not only the Treasury on an increased rate of change basis, but now we have the Fed assisting with the RMO purchases. And we have the 15 billion cash management purchases at the bottom with the 6 billion from the Fed. And then this is just a recap again of the move in the 2 different periods around the tax season and a reminder about the cash management purchases that I will read out. So the cash management purchases, CMPs, calm the move index by improving front-end liquidity, stabilizing funding markets, and anchoring short-term rate expectations. This reduces uncertainty, dampens forced positioning and hedging demand, and ultimately lowers both realized and implied volatility in Treasury yields. So the front end of the curve is where things can get quite jumpy and can cause the move to elevate in times of stress. So if we look at this chart, right, so in green is the S&P. It's from the document, but we've added a couple more bits and pieces. So in green is the S&P, and then in orange is the year-on-year net liquidity rate of change, including the move. And you can see that in this period, tax season 2025, when we sold off, liquidity went negative. And then if we go back to the move chart, we see that the move did not collapse in the same fashion that it did now, which is almost a vertical drop, right? It kept trying to elevate, and that kept liquidity tighter for longer around the lows. But in this instance, the cash management purchases had the move falling off in a vertical fashion, and that in turn increased liquidity at the fastest rate So that's the rate of change of the rate of change in the history of our liquidity model, essentially. So it was a very, very fast increase in liquidity. And then also, if we compare the two periods of time in terms of this is cumulative accepted cash management and liquidity support buyback purchases from the Treasury in 2025. So throughout cumulatively from the start of the year to the end of April, we had 85 billion from the Treasury. Right? Right now, cumulatively from the start of the year between the Treasury and the Fed, we have 275 billion. Right? So on a rate of change basis, we're up a lot. There's been a lot of support for this market, but as AP said, it's not coming through the balance sheet in the same way. It's coming through in these market operations. And now, I guess the delay that it adds is when they draw down on the TGA, that sort of thing, which is something that we were picking up beforehand. Now we don't just know that it's liquidity positive. We can look at exactly what they're doing and how that might impact price, whether it's just liquidity support or if it's volatility calming measures as well. And then this is just the looking forward on the schedule. So this week, for example, tonight we have 7.5 billion as a max size potentially from the Fed. And then we have $15 billion cash management purchase, which is the last cash management purchase until we get the new tentative schedule on the 6th of May. And then we have 4 billion of liquidity support from the Treasury on Wednesday. So it gets quite vulnerable after this week, basically after Tuesday, because the liquidity support and the RMO purchases from the Fed, they do help, but they're not as instructive as the cash management purchases, ultimately because of the impact that the move has on markets and also liquidity models worldwide and VAR models, as AP spoken to. Oh yes, and of course this is just a comparison between our net liquidity level in total and the TGA, which has recently topped up almost to 1 trillion, as we've spoken to. And that obviously has an inverse correlation, particularly in the current market environment. And quickly, I will just show what AP's been speaking to. Yeah, we've been working with a great friend of mine, Mert, to improve our liquidity model in terms of its integrity, but also how we interact with it. So we've taken the different various spreadsheets and we've turned it into a database, and then also created this web page where we can test all of our different readings on liquidity against different assets from the Fed or from TradingView or our own generated assets. We can take the data all the way back to 2003. I mean, I think if I go all data here, that's not right for that. Anyway, I'll come back to that. But we've got a whole bunch of assets in our series catalog, and it's a great tool that we are working on to improve, and we'll very likely release this to you guys as well once it's at that level. I think that's it.
Yeah, great.
For me for now.
Yeah, thank you. Now, Mert's on the call, and thank you, Mert, for the work you're doing on that. I think the observation again, that's what markets do, right? They always continue to teach you. I think the pillars always keep the integrity of the process, and certainly from my perspective, we were very conscious of the fact if certain markets came back through their outside range, lower quarter bars and so forth, just be careful. I mean, to be honest, I was like the rest of the people in the market. I was shocked at the magnitude and the swiftness, but the technicals were very, as we showed yesterday in the long form note, were very instructive. We got that outside range higher bar at the low into that buying. And then we knew CTAs were record short. We knew the market was underinvested, and the rest is history. So we'll incorporate that and go forward and understand that again, it's crucial you run it through. I think the integrity of liquidity. It's always easy to look at that liquidity scorecard. If we just had been buying on the basis of them buying of their cash management, well, the market had gone down 10% while they were buying, but they finally got people off guard and caught them short. So where have we landed ourselves in? Basically, this is the chart that I still like the most, and that's the short Europe it is the index that's not behaving well. I still like the agriculture against it. So that's it's short Europe and long corn and wheat. And again, it is back through the sort of reversal lower quarter, but so once it comes back through that, I probably will press it further. We'll see how the market opens this morning. Again, on Japan, just quickly, yeah, the Nikkei has responded very well, but this is dollar yen. The dollar yen, where it went to last week, was that high, is the date that the Prime Minister was elected, and also the date that the war started. So the dollar, which it's trying to weaken, no question, and that's a liquidity positive, as we know, it assists the M2, it assists the global system because it's borrowed in dollars. But ultimately, we're not getting confirmation. So the Aussie dollar is, dollar Sing is not, dollar Swiss is not. Euro went up against 118.10, which was the war high last week. Dollar yen went to the 157.70, which was the war high, didn't confirm it. So while the market went on an 80-year rip, other factors like yield curves, currencies, and certain other factors are confirming. So we're still not giving the green light to go all in and long. On that note, I'll pause and then hand it over to Brian on the ags.
Thank you, Andrew. And the grain complex this week saw price action that was led by wheat, with strong upside moves in both Chicago and Kansas City, the HRW and SRW contracts. Corn was modestly higher, while beans were softened slightly on the week. From a structural standpoint, we see corn and wheat remaining in a carry position, indicating that there's no immediate supply stress, while soybeans continue to show an inversion. And what that means is that that longer dated, that outlying contract for November of 26, you'll notice that that's higher or lower, than the current May contract or the near-term contract. So that's reflecting supply through an inversion, meaning that it's you're paying your folks to store the grain, or in this case, store the soybeans. So we are looking specifically at no immediate supply stress. Corn's trading in a carry structure with moderate volatility, and it remains a heavy long position from a fund and commercial standpoint, and that creates support, but can also flip to downside if people start to liquidate. And again, we talked about that tight supply through inversion in beans, and we're not seeing any volatility in a very crowded trade there. And of course, wheat is where we're seeing the most notable change, with strong weekly price gains, elevated volatility, and relatively clean positioning. And we feel that that's where you're going to get your most asymmetrical return, is with Chicago or Kansas City. So looking at it from a pillar standpoint with geopolitics, we believe it's very bullish grain led by wheat due to the Iranian conflict and the Strait of Hormuz instability, not to mention the long-term impacts to energy, that freight supply, risk premiums, as well as support input costs and global grain pricing. Wheat is the primary geopolitical hedge to the global trade sensitivity. Our non-traditional liquidity showing strong support for commodities. And obviously, we're watching that as grains are a secondary beneficiary to what's happening in a larger fund and flow context. So our third pillar, obviously, is our monetary and fiscal policy, and that is mixed to slightly negative with that demand backdrop and weak consumer confidence. We're seeing our market structures we talked about in greater detail, with no immediate supply stress and upside optionality. Our positioning and execution, wheat again is the clean position, with corn at second and beans a third, and that's due to the crowded risk. And we feel that the overall balance sheet is showing a bullish forward risk. So the key takeaway is that while the fundamentals are stable, macro forces, particularly liquidity and geopolitics, are beginning to reprice this risk in grains, and wheat is leading that move. And we've been long since February here and continue to to support that trade. And when the conditions and factors flip, we'll be the first to let you know.
Thanks, Brian. Yeah, and again, great stuff. It's going to be fascinating. I'm going to be interested to see how the grains do trade this week. Yet again, that's a market that is heavily influenced by the supply shock. I don't think are fully in the price yet. So I'll throw to Stephen. I mean, before I do, we have a lot. We don't have a lot out this week, but next week and the week after, it's all central banks are going to have to deal with the reality of the last 3 to 4 weeks. We've got the FOMC next week, the BOJ, ECB, BOE. We've got the quarterly CPI in Australia, which will be a huge number after a reasonably strong employment number. And then you got the RBA following. So, Stephen, your thoughts and observations, sir?
Yeah, good morning, Andrew. Good morning, everyone. I'm here in heavily medicated Melbourne. So I'm making no comments about the energy supply shock dynamics and prospective cascading through the petrochemical and agricultural complex. Well, we're still in stagflation mode, so that's the backdrop. But what I will comment on is Nick's work, Andrew's work, Revol, and the fact is that this house has a little. We've been a little burned by GFC and COVID and everything, and we have an absolute focus on liquidity, right? So we're sort of liquidity fighters, fighting for justice and freedom and everything. Now, everybody else has noticed this too, right? Sorry, we have done it in our way, but the big houses will be watching this narrow Bessent focus too, and they'll be watching the SOMA, the Fed's SOMA balance of Treasury holdings, and they'll be seeing how narrowly cast this liquidity upswing is. It's not general. It's not driven by global events. So that will be of interest to them, particularly given how short they were caught over the last 20 days. All right. So we've got a 20-day movement, which is one for the ages, right?
Yeah.
And it's all driven by volatility, and volatility is fundamental, as we've discussed before. On the others, and in addition to that, we've got earnings, US earnings, which are coming in early days, incredibly strong. It's just incredible,
Yeah.
That's incredible, right? So we've got the S&P, the Nasdaq, pick your index, but they're all at record highs. They're at record highs, guys. This is very interesting. So either the market knows something, either the equity market is telling us something about the Straits of Hormuz and the way that the Pentagon is prosecuting this blockade, and that we're close to some sort of breakthrough there, or this is just a complete state of beware, of whiplash. Now, I don't know. There's just not been enough time to judge that there's been enough fundamental change in the economic side to make any call about this. So I tend to sort of stay on the whiplash side, and that things could rip in the other direction, because we're dealing with volatility here. So that's my little sermon for today.
Yeah. No, our sermons are. You're right, and anyone that didn't do a lot of work to look at why we saw such a rebound probably shouldn't be in the business, because there's a lot of learnings of what occurred. Momentum is a factor, positioning is a factor, to your point, and that's why we're trying to look at what's the yield curve doing, what's the dollar doing, what's other things doing. Again, back in 2020, if we were sitting having the same conversation, we saw what the impulse that came in on the balance sheet and the fiscal and so forth, we would literally say, well, just go and buy everything, go to the beach for a year, because the rate of change was off the charts. That's not happening now. Now, to Stephen's point, there's so many other variables that you've got to be respectful for, and the most respectful path you must be is the price. Price is the ultimate determinant. But we remain in that camp as to Stephen's sermon that if we start seeing a bullish steepener, that is, rates are coming down, we start seeing the long end not responding to the supply shock and the inflation concerns, and we start seeing the dollar not weaken materially, we're going to have to lean on the fence of it's a whiplash. Thanks, Stephen. Currency corner, Matt, and then scorecard, or either way, whatever.
Thanks, Andrew. So looking at the currencies this week, we're still viewing them as a key driver, but they are currently the least volatile asset. The dollar weakened quite materially last week, although it did reverse a bit on Friday. So looking at the Aussie as the main focus, the strongest on the week. They had strong labour market data come out through the week. Still got high inflation and an RBA that has been holding a stronger tone, focusing on the inflation side of the mandate. There's still 42 basis points of hiking priced into the curve through the end of the year. Next one's going to look at the Swiss franc and the dollar NOK. These have been benefiting from the weaker US dollar on the week, as well as Nasdaq strength. They picked up a high equity correlation there with Swiss as 0.86 and dollar NOK as 0.94. This is related to the high international net international investment position that we've spoken about for some time. The pound and the euro started the week stronger against the US dollar, and they put in some outside range lowers to end the week, closing lower against major peers outside of the US dollar. The yields came down through the week as both UK natural gas and European natural gas energy prices fell. Both the ECB and the BOE tempered expectations around rate hikes throughout the week. Looking at the yen and the Sing, we had dollar Asia quite weak through the week, moderating with energy prices and headlines around the Strait reopening. The yen remains the most bearish against all major pairs, aside from the US dollar, with putting in reversals against the euro and the Aussie dollar on Friday. That's it from the currency side.
Thanks, Matt. Scorecard.
Thanks, Matt. Yep. All right, so leading for the stocks this week, we have the Nikkei and the Russell, positive 41 and positive 35, and then lagging, we have the stocks, the Euro stocks, sorry, and the ASX. And then for the yields leading, we have the Japanese 10-year and 2-year, been there quite some time, maintaining the highest scores on the scorecard pretty much. And then lagging, we have the US 2-year and 5-year. The US 2-year giving up 10 points in line with the bull steepener in the US curve. And then in commodities leading, we have silver and gold. And lagging, we have platinum and oil. Oil giving up 13 points, platinum gaining 18. And then for the ags, we have soybeans and wheat leading in line with Brian's eye on ags. And then lagging, we have cocoa and sugar with a negative 26. And then for FX leading, we have the Aussie dollar and the pound. And then lagging, we have dollar Sing and dollar yuan. Dollar yuan negative 35, which I believe is still the lowest score on the scorecard. And then crypto remains weak, but obviously a little bit lighter in recent weeks. So Ethereum is almost flipping positive. Crypto's come from pretty deep negative scores over the last month and a bit, of course. So yeah, we're almost looking negative for Ethereum there, trying to close that gap. And still led lower by Ripple though, with a negative 18. And then for the sectors, we have the EEM, which is the emerging market equities, at 38, and then the real estate sector at a 33, leading the section. And then lagging, we have XLF and XLV, the financials and healthcare sectors. The healthcare sector, is the only negative score for the section at a negative 12. And then for the countries, South Korea and Brazil are leading at a 38 and 35, and then lagging, we have Germany and Mexico. And I'll quickly look at the 1-week changes. So the communication services sector and the consumer discretionary sector led, followed by the DAX, Germany, Kiwi, and the S&P. And then lagging dollar CAD was down the most, followed by dollar Swiss, oil, the US 10-year, and dollar yen. That's
Great.
all from me.
Thanks again. Yeah, again, I can't encourage you more to familiarize yourself on the scorecard. It does take a lot of the bias out, particularly during times when it's less certain. We haven't added another date for some time because really it's almost impossible to find a date with Trump doing what he does each day. But we will when we still remain 2nd of March as being the most critical recent date. We obviously have the 30th of January, which is we have to be conscious of that because that was the Walsh appointment date. But equally, I think he's before Congress this week. Is that right? For his
Scheduled to be. There's been some delays. We'll follow up.
right. So I have to keep an eye on that because the dynamics of the Fed will be critical. Obviously, as I spoke to the FOMC, BOJ, ECB, and BOE all next week. So this week's not really anything other than headlines and the war.
And lots of earnings. Yeah.
Lots of earnings as well.
Yeah.
Yeah, it's earnings season. So that's to your point previously, Steve, and the other Russells being one of the leaders there, which is picking up your point regarding earnings. Private credit, it's still lurking in the background, and obviously the fuel reserves that we've spoken to at length. So we'll continue to retain that sort of conservative position for long only. And when I say that, I mean look at that sort of real world economy. I think that's going to be the thematic for some time. It's not something still that we can be comfortable to move it beyond conservative because we still think there's too many inconsistencies through the pillars to be supportive, but nonetheless, very respectful of the price movement in the last 2 weeks. Our active positions have trimmed a lot, as they should have been. Long wheat and corn is still our prominent position with the short European stocks, which remains under all the dates that are critical for us. So I do believe currencies and yield curves will be the ultimate determinant. They tend to be the driver. I think last week the subtlety of the curve shifting to that sort of steepener from lower rates is interesting in of itself, and we'll see how that then plays out as the market opens shortly, which again will get a lower price, and we'll see how it plays out. I mean, I'm happy to take, and I don't know, a couple of people maybe that said last week, if anyone has any questions, happy to take one or two if anyone has them. If they don't, then we'll close the call. I'll take that as a no. Walsh is on Tuesday, Penn said. Thank you, Penn. And thank you, everybody. We'll update you no doubt during the week. And thanks again for your time.
Have good weeks, guys.
Cheers.
Everyone.
Thanks, everyone.
You guys.
Thank you.